Jamie, Kaidi, thank you very much for joining me. Today, as you know, we're talking about disruption in the venture capital world, specifically around the rise in token offerings, or ICOs. Let me give you some numbers. So in 2016, there was $260 million raised in ICOs. In 2017, there was $3.5 billion raised in ICOs. And we already know at least one company, Telegram, is raising $2 billion early in 2018. So the numbers are set to grow dramatically again. And I think in this panel, we want to discuss specifically what's driving this phenomenon from a structuring perspective, and what's going to be taking place, and how is this going to be impacting venture capital moving forward. Jamie, I want to kick off and ask you a question just about kind of the benefits of doing an ICO. Can you tell me a little bit about why you recommend companies go through an ICO process as opposed to raise venture capital?
Sure, well obviously it depends on the project. The companies that we advise, often they're existing businesses that require network effect to scale. And so previously they'd be looking at raising a very large amount of VC money, taking a lot of dilution, and then having to kind of navigate that path to product market fit, their vision, by winning customers along the way. And so their path to kind of get to that vision is somewhat of a snake, and 90% likelihood that they'll die along the way. So for them and for the investors, it's not a very efficient and effective way to finance innovation. The benefit of tokenization is that primarily in utility tokens anyway, the technology is open sourced, significant amounts of capital can be raised, and they can begin executing on that vision day one. And when you're building protocols, it's more about building network effect by developers building on top. So when you can issue your own token, effectively you can use that to incentivize early adopters. So you're effectively printing your own money to buy market adoption rather than raising a lot of capital and being diluted.
Great. And I guess if we simplistically compare it to VCs, it's generally at a higher price with less control given up to the dirty VCs like myself.
That's true, but you could also say, especially if it's open source, there's a premium on that asset because it's less fragile, because you're not dependent upon one team to execute. Things can be forked, which effectively means you can create a derivative, a copy, right, that can be run in parallel or replace entirely.
Great. And Kaidi, a little bit of a follow-up question. I mean, do you think this is a better way to access capital, or is this fundamentally a better way to actually structure and create a business going forward?
Both, definitely, because when we look around, then for the companies, the question is who has the capital? Who has the capital that would enable you to run and build up your business? And can you unite those capital using different vehicles into your company? And from the founder point of view, you can have VC money, but VC money, as mentioned before, is coming to the equity. Can you fund building up the product? Can you fund building up a technology and the blockchain or the protocol layer? Can you fund building up your community? So the ICO provides the different vehicles, the way you can structure your company and the way you can fund your journey to the global business.
Great. Jamie, one of the or some of the terms that we always hear bantered around the token space are security tokens versus utility tokens. I wonder if you tell us a little bit about the difference between the two.
Sure, well, I mean, some people say that there is no difference, and it also comes down to how these things are marketed as to which class they might fall into. But fundamentally, the concept of a utility token is that there is a token that is digitally scarce within a web system, primarily open source, and it is the unit of value in that system through which various rules can be programmed. So if you think about it almost as a commodities layer, this kind of asset class that allows the system to function and incentivizes stakeholders effectively to coordinate that digital economy. A security token is a little bit more simple in theory, which is you can, with digital scarcity, you can introduce the idea of having a digital unit of value that can be totally synthetic, or it can be pegged to a physical asset, allowing it to be tokenized, fractionalized, and then securitized and traded in a secondary market. And I'm a big believer that the security token model will be pretty much applied to everything and anything because of the liquidity that it can bring to an asset class.
Right. And I think if we look back in time, it's part of the way to understand it is to look at historically how the SEC has thought about this. And I believe it's called the Howey test, and it dates from the 1930s, which is actually related to orange juice futures, believe it or not, and how that was structured then. But I think the idea is that if it is a security token, someone is buying it with the expectation that it could go up in value. And a utility token is someone is buying it because they believe it could be used in the network as a form of transaction kind of liquidity to help promote the service itself. Kaidi, I want to chat a little bit about crowdfunding and perhaps something we can learn from that, because obviously Funderbeam is a combination of tokenization of crowdfunding as well. Can you maybe tell us a little bit about your thoughts about how the evolution of crowdfunding has taken place and what we can learn with respect to ICOs?
I think what the crowdfunding taught us is that there are tons of people who would like to take part of the innovation. They would like to support it, and the incentivize of supporting is not just the financial return, but it's about just joining the journey of the entrepreneurs and touching the innovation when we talk about the Kickstarter, for example. Now, the second wave introduced was the equity crowdfunding, is that you could invest into the equity level of the companies building new products or the services. But in the crowdfunding, what is the missing piece is the liquidity, and this is exactly what the ICOs are building in. And the ICOs, because they built on the blockchain technology, it enables to cut out so many intermediates that provide the trust, saying that, for example, if I invest in your company, then your tokens belong to me. And this is now built in the technology, and it makes it faster, global, and also secure.
Excellent. Jamie, I want to touch a little bit about regulation. And you guys are obviously very involved in helping companies prep for ICOs and actually deliver those ICOs as well. I know there's been a lot of chatter out of the FCA in the UK, the SEC in the US, and instruments like SAFs, which I believe are Sales Agreement for Future Tokens. Can you tell us a little bit about kind of how regulation is evolving in the space, and more importantly, how you think it will continue to develop?
Yeah, so I mean, I think at the moment there's a lot of ambiguity. We're starting to see regulators increasingly provide greater clarification on what may be determined as security. You've got to remember, in large part, these regulators are primarily looking after local markets, and they're looking to protect retail investors, and that's their primary concern. So most of them kind of, you speak to them off the record, increasingly they're becoming comfortable with this asset as an innovation, primarily to power the web, but potentially with broader remit and scope. You're starting to see some jurisdictions like Singapore and Switzerland leading the pack with greater certainty, actually by laws stating what is and isn't security. You're starting to see people like the finance minister of South Korea stating that you can't have public blockchains without crypto assets. So a lot of regulators are kind of warming to it. They're trying to not throw the baby out with the bathwater whilst protecting retail investors. And I think this is going to be a really critical point, because what we're seeing certainly in Europe is there's huge appetite. Previously in the VC world, which is very relevant to the audience at this event, you always had to concede to the states at a certain point of growth. What we're starting to see is Silicon Valley is being fragmented in terms of smaller investor groups, syndicates that are forming, are native to crypto, and then also geographically. So Europe last year was the primary issuance market for ICOs.
I can also add to the regulation point of view is that when we talk about ICOs, we should split it into two phases. The first is primary markets, investing. And in this, what the regulators do, they ask if what you're issuing is a security or not. If it's a security, it goes under the public offering rules.
Right.
And the second, what is even more difficult piece is the trading. Once you issue the security tokens, can you ever trade it without the license? And in here, Europe is lagging behind, because in Europe the trading is heavily regulated, and this is, for example, why the Singapore stood out, is that they enable trading the security tokens.
Great. I want to dive in a little bit about the role of venture capitalists going forward. So I represent an early stage technology fund. Right now, we actually cannot buy tokens. We are amending our limited partner agreement, so we will be able to buy tokens in the future. A whole host of issues around cold storage, et cetera, moving forward. But how do you think about how ICOs and venture capital can work together. I mean, Kaidi, do you tell your companies to even speak to VCs?
Yeah.
Jamie as well, when you're advising companies on token offerings and investing into them, should they speak to VCs?
Yes, I do, because I think that the future is the combination of different investors, because they all touch the different angle, they all touch the different arm in the life cycle of the startups. But around the VCs and the investments, what they need to think about where the value is created, and whether the value is created on the equity level, whether it's created on the token level, and if the token is either the protocol token or any other tokens, where the value is created, and also for the VCs to build up the portfolio and the investment possibilities around the new way of thinking, where the value is created.
Yeah, I think there's a couple of levels to it. So the first thing is that money's quite cheap at the moment in the crypto market, primarily because if you can issue your own currency and then recycle the gains from that into new currencies, it creates an entirely new capital base. So we are starting to see hedge funds and some VCs move into this asset class, but primarily the kind of seed money is being filled up by these kind of crypto syndicates or crypto hedge funds. And the important point is increasingly allocation is difficult to come by, because just being a source of capital isn't good enough now. So what we're starting to see is a number of these syndicates are kind of offering out services to help promote a market. Our own model is we're an advisor first, and we kind of underwrite the process with capital. So our function is primarily as a signal to the market, and that's still needed, because in large part it's still a very opaque market. There aren't the kind of standards of reporting for these foundations and organizations. So for most investors to be able to understand the increasing complexity in the technology, secondly to be able to have surety around the governance, it's really kind of a very limited amount of people that can really see both of these things and understand them under the bonnet. So hopefully what we represent to the market as Outlier is a signal where people can trust that there are some grown-ups in the room that are doing the DD, that are ensuring that governance standards are in place, and therefore the rest of the market can have surety.
And I think it is interesting because a lot of people use the terminology the Wild West right now for the ICO space. And I think you're trying to say you can be a little bit of a sheriff in one of the towns, at least. Before we close, I wanted to ask both of you just your thoughts on, we're here at a conference that's all around venture capital, it's around Europe as well. And traditionally, those have been dirty words. European venture capital, Europe's behind the US, and then also the time to liquidity has been an issue in venture capital as well. And I think both of you who are not traditional attendees of this conference kind of leaned into me and said, wow, I think blockchain, ICO can solve some of these. I was wondering if you just expound on that a little bit. So Europe's leadership role and then also around time to liquidity.
Well, for the just to reflect what you ask is, I'm a founder of a startup that was born in Estonia. So to getting access to the capital from this small, tiny little country, it's really difficult. And when you go to the Europe and you say you're going to build a global stock market on the blockchain, then European VCs look at you and say, yeah, right. So, and we had a discussion with whether we should go to US or we should go to Asia. And we decided to go to Asia, not just building up a business and going and expanding the Asia Pacific market, but also go and meet the investors there. And I would say they are more about the risk, and they are more about looking into the future, because sort of they just stepped into the scene and this is their reality, whether for the European VCs is the future. Yeah. And I think that when we think about the blockchain and the ICOs, and Europe has an opportunity to give for the companies a possibility to build up ventures like Funderbeam does, or to kind of give the exemptions on the ICOs so that we could test it and then regulate it.
Yeah, so the two different questions, the liquidity piece first. So obviously the great thing about this asset class is its liquidity almost day one. There's a secondary market. Relatively thin liquidity until things start listing on exchanges, but liquid nonetheless, which is a double-edged sword. So on the one hand, it's great for the founders, it's great for investors, but of course you need to ensure that the kind of the people that you're hoping to drive the technology forward are aligned to actually realizing it rather than just raising money. So, for example, with the projects that we're involved in, our holding vests alongside the founding team, sometimes over a 3-year period. So we're starting to introduce some lock-ins, and equally that's being asked of early stage investors in pre-sales, and sometimes theirs will vest over a 12-month cycle.
Right.
Might have a cliff at a certain point. So 2017 was total liquidity. 2018 is going to be a little bit more aping traditional venture liquidity, but what you are starting to see is the new funds, the crypto funds that have been created in the space aren't structured like a VC firm. They're largely being structured like a hedge fund in order to capitalize upon that liquidity. In terms of Europe as a market, it's a huge opportunity. As I mentioned earlier, we were the number 1 market for issuance last year, and I think that will probably continue into 2018. If you look at the trends typically in early stage investing in Europe, and this was talked about on a few panels earlier in the day, they might be locked in to 10, 15 year period where they might get any liquidity, both the founding team and the funds themselves, and they're kind of waiting for this event, be it an exit through IPO or merger and acquisition. And a really interesting thing in this market, certainly for the utility tokens, because they're primarily open source, there is no event. So you're not gearing up to an exit, you're not gearing up to an M&A. Actually, it's just a very phased release of liquidity.
And as when we talk about the liquidity, what the ICOs and tokenization would allow is the liquidity on 2 levels, the LP level and the portfolio level. Right. So both could be trading.
Great. Thank you guys very much for that. I think, just to leave you with one thought, the sums that we're talking about, the average ICO is 15 million, but we're talking about amounts up to $2 billion being raised in a single coin offering. And so I think the implications are broader than just for venture capital. If you look at larger growth equity funds, private equity, or even stock markets, it's going to have implications for all of us going forward.